Welcome to Spidell's Federal Tax Minute. I'm your host, Catherine Zidane. This week we're covering the basics of reverse mortgages, such as the types available, eligibility requirements, and more. Attend Spidell's Federal Tax Update webinar and be prepared for the 2024 filing season. This 8-hour course will cover everything that happened during the year, and you can see a list of topics covered and get registered at spidell.com under webinars. Reverse mortgages help generate liquidity for individuals who don't have much cash, but who have equity in their homes. A borrower can turn the value of their home into cash without having to repay the loan each month. It's known as a reverse mortgage because the payment stream is reversed. Instead of an individual making monthly mortgage payments to a lender, the lender makes payments to the individual. The loan offers tax-free proceeds, and there are no income requirements for the borrower. But an individual who has a reverse mortgage might have trouble qualifying for Medicaid, and there's no tax deduction for mortgage interest until the year the loan is actually repaid. There are several types of reverse mortgages: federally insured home equity conversion mortgages, which are administered by the Department of Housing and Urban Development and are only available through FHA-approved lenders; single-purpose reverse mortgages offered by state or local government agencies, which are typically the least expensive reverse mortgages; and proprietary reverse mortgages offered by banks, mortgage companies, and other private lenders, which are typically the most expensive option, but the maximum mortgage amounts exceed an FHA reverse mortgage. To be eligible for a home equity conversion mortgage through the Department of Housing and Urban Development, a homeowner is required to be at least 62 years old, own the property outright, or have a low mortgage balance that can be paid off at closing with proceeds from the reverse loan, occupy the property as the principal residence, not be delinquent on any federal debt, have financial resources to continue to make timely payment of ongoing property charges like property taxes, insurance, homeowner association fees, etc., and participate in a consumer information session with a HUD-approved home equity conversion mortgage counselor. The home has to be a single-family residence, duplex, triplex, 4-unit residence, FHA-approved manufactured home, condominium if it's approved by HUD, or a manufactured home that meets FHA requirements. The maximum loan amount is based on the age of the youngest borrower or eligible non-borrowing spouse, the current interest rate, and the lesser of the appraised value of the property, the home equity conversion mortgage loan limit of $1,089,300 for calendar year 2023, which is further limited by location, or the sales price in the case of a home equity conversion mortgage for purchase. This means that the older the taxpayer is and the lower the interest rate is, the higher the maximum loan amount will be that the borrower can be eligible for. Interest accrues on the outstanding balance of the loan, but principal and interest don't have to be repaid until the borrower dies, leaves the home, or sells the property. At that time, if the balance due on the loan exceeds the value of the home, FHA insurance pays the difference. The borrower may be able to refinance the reverse mortgage and pull out additional cash depending on the property value, the interest rate, and the age of the homeowner. Spidell's Federal Tax Letter is a monthly newsletter plus a searchable online archive of back issues that keeps you at the leading edge of the federal tax issues that will impact your clients, from healthcare to trusts and from LLCs to virtual currencies. You can see subscription information and download a sample issue at spidell.com under Publications. That's all for this week. Join us next time for another episode of Spidell's Federal Tax Minute.